Let's welcome in Cameron Dawson of NewEdge Wealth, Joe Terranova from Virtus Investment Partners, Ellen Zentner with Morgan Stanley Wealth Management. They are all with me, as you can clearly tell by now, at Post 9. Welcome, everybody. It's good to have you. All right, Cameron, so we had a lot thrown at us this week. The market's been pretty resilient. If it was down a lot more than it is now, you'd say, well, I understand that, given the tensions in the Middle East, the port strike, and a lot of other stuff, too. What's your view?
Yeah, and you add on top of that seasonality. We do know we're in this tougher seasonal stretch. Just because it didn't result in a lot of wheat markets in September doesn't mean that we're necessarily out of the woods for October. And so we do know typically going into an election, that is what we get. Now, the one thing to watch is that with oil prices moving higher and potentially adding to inflation, that is the one thing that could catch the Fed dead in its tracks for the cutting cycle. And I think that that's why markets are reacting to higher oil prices today in a negative way. Now, it's a big question of does that actually filter through higher inflation?
The big reason, Joe, that some say the market's brushing all of this stuff off and treating it as noise for now is because the Fed's cutting and the economy's pretty good. And we got more evidence of that today, as I said, with ISM services. Is that how you see it?
Oh, we are clearly in a secular bull market. Global central banks, the percentage of global central banks that their last policy action was a rate cut is now at 65%. We haven't seen that since October of 2020. And yes, there are signs in the eco data that the consumer, maybe they just paused their spending intentions over the summer. It seems as though it's reaccelerating. So I think ultimately, you've got some election angst. Once we get past that, you get the clarity surrounding the election. On the other side, you ultimately make a return to business investment once again in consumer spending. But unfortunately, geopolitics has control of the near-term price action right now. It's lifted the VIX above 20, and it's all about energy right now. You've got the XLE. It's done 16 million shares so far today. It's the leading sector out of the 11 major S&P sectors, and there's far more room for oil to run because from a positioning perspective, it's bearish. Sentiment is skeptical. The 200-day moving average is only at 77.50.
The real question is, to what degree is the market going to be disappointed by the size and speed of rate cuts? It goes to what the chair of the Federal Reserve, Jay Powell, told Ellen Zentner, the same one who's sitting on our set today, by the way, that they're in no hurry. Listen.
This is not a committee that feels like it's in a hurry to cut rates quickly. If the economy performs as expected, then that would mean 2 more cuts this year, a total of 50 more.
Well, you got the goods from the Fed chair, who sort of dialed back everybody's expectations. Were you surprised at all that was the answer he had?
Well, I think when you look at the data that the Fed has in hand since their September meeting, these benchmark revisions to GDP and GDI, gross domestic income, were significant, and especially GDI being revised up. So now you have much higher corporate profits than we thought, lower labor costs than we thought, higher incomes than we thought, greater spending than we thought, and the savings rate is still high, even higher than we thought. So that cushion is still there. So as he put it in that appearance on Monday, it gives him more confidence that the labor market won't weaken so much that they have to speed up. That doesn't mean that there's not a low bar for going 50. And I think you've got that employment report coming during blackout. That's the meeting where the employment report could look pretty muddy if these strikes last long enough. And so having ample room to cut, the chair's own word, ample, means that 50 is not that big a deal if the unemployment rate rises and they feel that they need to continue with 50s.